Now, material variances. What is material variances? In any production, when we see certain material is always used as an input, and without material, that production is just not possible. You take anything in the world, and when it is there in a tangible form, you see some tangible form of material is used in that. For example, now say, take a case of furniture. Now, in case of furniture, wood is the raw material. So material is going into that. Now take a paper. So in case of a notebook, the paper is the material. Now in any such example where you see some or the other material is going into the production process, now when that material is used, then how that material cost could be controlled, and then if possible that material cost could be reduced to increase the profit margin of the business. And from that point of view, we calculate material variances. Now what is material variance? Material variance means we compare standard material cost with the actual material cost. What is standard material cost? Standard material cost is that material cost which business was expecting and anticipating to incur to manufacture a particular type of goods. Whereas, what is actual material cost? Actual material cost is the cost that business has incurred or spent for procuring that material, which is a prime factor for the production process. So, how this standard material cost is calculated? It is very simple. The standard price of that material, say per kg, per liter, per kilogram, whatever. So, that is standard price into standard quantity. So how many units were required and at what price business wanted or estimated or expected that to buy for. If you multiply these two, standard price SP into standard quantity SQ, you will get standard material cost that business was anticipating and expecting to incur to manufacture a particular types of goods. Now against that, we have actual material cost. Now what is actual material cost? Actual material cost is the actual quantity of the material consumed. See, actual number of units in kgs or liters or meters or whatever, and the actual price per liter, per kilogram, per meter, etc. paid. If you multiply these two, you will get that actual material cost, which is nothing but AP into AQ. That is actual material. When you actual material price and then standard material price you compare, you could get a difference, either positive or negative. Just for example, I have given you there below. You see, the standard material cost in first case was 25,000 and actual material cost was 23,000. That means business was expecting to incur 25,000, whereas business has incurred only 23,000 on that material. So business has saved here 2,000 rupees in the cost. So we can say to that extent the profit of the business must have increased. So it is a good sign. It is a positive difference. It is a favorable sign as far as the profit of the business is concerned. So this positive difference we call as 2000 variance. And since it is a positive, we call it favorable. That's why in the bracket you find that capital F. Take the second example. In second example again, the standard material cost that business wanted or estimated or expected to incur was 25,000, whereas the actual material cost incurred by the business is 28,000. We can see here 3,000 extra are spent by the business on this material, and for that the profit margin of the business has reduced by that 3,000 rupees. So it is not definitely a favorable sign for the business. This is definitely going to take out the profit, or it might increase the losses of the business. So this unfavorable situation to the extent of rupees 3,000 we call as a negative variance, and which in standard costing we call as adverse variance. So that 3,000 we write in bracket with capital A as adverse. So whenever standard cost is more, it is favorable, and whenever standard cost is less, as you can see in the second example, it is adverse. In detail, we are going to see all this with example. This is just to make you understand how these variances are calculated as favorable and adverse variance. Now, These material variances are further divided into two variances: material price variance and material usage variance. There is one more material mix variance, but that is not there in the syllabus of third year this commerce degree, that is there at master's level. So we will restrict our this today's lecture to material price variance and material usage variance, the two major types of material cost variances. Now, first one, material price variance. Now, since you see that price word in between, it is the difference between the standard price that business was expected to pay per kg, per liter, per kilometer, per meter, etc. And that compared with the actual price paid per kilogram, per liter, per meter, etc. And this difference between the price, that is standard price minus actual price, we compare for the actual quantity utilized for the production process. Now, actual quantity could be again in kgs and then liters and meters, in tons, and whatever may be the parameter. So the first variance in material variances is material price variance, where we compare price, that is standard price minus actual price, and that difference we multiply by the actual quantity. And if this answer is positive, it is favorable variance. How it will be positive? When standard price will be more, it will be positive, and when actual price will be more, it will be negative. So for positive variance, we'll call it as a favorable variance, and for negative variance, we'll call it as an adverse variance. Now, second type of material variance is material usage variance. Now, from that word usage, you will understand it has to do with the number of units, the quantity utilized in the production process of the material. So how many quantities were to be used? That is standard quantity. And what is the actual quantity used? That is the actual quantity. When you compare these two, that is standard quantity minus actual quantity, and when we multiply that with the standard price, then we get the variance, which is because of the usage of the material, the quantity used in the production process. And when standard quantity is more than the actual quantity, we will have positive variance, that is favorable variance. And when actual quantity will be more than the standard quantity, it will be having a negative variance, and that will be called as an adverse variance. In the four examples which I have given you below, you can understand. So in the first case, standard price was 12 and actual price was 10. So standard price is more by rupees 2, and that 2 into 4,000 is 8,000. So here the business has saved 2 rupees per kilogram or per liter or per meter, say on 4,000 kilos. And like that, the business has saved 8,000 rupees, say, on account of the price of the material. So this is 8,000 favorable material price variance. In the second example, you see standard price of the material was 12, actual price of the material was 13. So here business has paid 1 rupee more per kilogram or per liter or per meter, whatever, on 4,000 say kilograms. And like that, business has paid 4,000 extra more towards the price of the material. So this is 4,000 adverse variance, because here the actual price is more than the standard price. Now take a case third one, where the standard quantity 4,000 is compared with actual quantity 3,500. You see standard quantity is here more by 500. That means 4,000 say kilograms of the material were to be used, but in reality 3,500 kilogram material only used. So 500 kilogram material is say saved, and for this 500 kilogram material, at the rate of standard rate of say 12 rupee per kilogram, business has saved 6,000 rupees. So this is 6,000 favorable variance on account of material usage, that is 500 units less used or consumed by the business of the given material. And see the last example, where standard quantity was 4,000 and actual quantity is 4,400. That means here business thought of only purchasing or utilizing 4,000 kilograms of the material, but however in reality 4,400 kilograms of the material were consumed. So 400 kilograms of the material were consumed extra, and for this 400 kilograms extra, at the rate of standard rate of rupees say 12 per kilogram, these 4,800 are spent more, and that is an adverse variance as far as material usage variance is concerned. And we have to always understand that material cost variance MCV is always equal to material price variance, that is MPV, plus material usage variance, that is MUV. This always has to tally. Now let us see, when we do addition or say summary of the variances, then how it works. These are the basic three rules that one has to understand. When one favorable variance we add with the other favorable variance, the resultant variance has to be favorable. For example, say material price variance is favorable plus material usage variance is favorable, so material cost variance will also be favorable. Now, second example, adverse variance plus adverse variance is equal to again an adverse variance only. Say, for example, when material price variance is adverse, when material usage variance is also adverse, then the resultant material cost variance will also be adverse. And the third and very important final thing, when we have one variance as favorable, that is positive, and the other variance as adverse as negative, and when we have to actually add both, you cannot add favorable to adverse and adverse to favorable. In that case, the difference we have to work out as given here in below. See, whenever the one variance is favorable and the other one is adverse, we have to take the difference, and whatever difference we get, to that difference we have to assign the side of that variance which is more. So for example, when favorable is more than the adverse, the difference will be a favorable variance. When adverse variance is more than the favorable, the difference will be adverse variance. And that I have given you in the four actually equations below. When favorable is more than adverse, the difference will be favorable variance. And when the adverse is more than favorable, the difference will be adverse variance. All these we have seen by way of examples in the following slides. Now let us take this example. From this example, we'll see how actual variance calculation is done and how the problems are asked in the examinations. Suppose you are given that 10,000 units are produced by the business and 22,000 kilograms of material X is consumed at the rate of 4.25 rupees per kilogram. Now, this is what is called actual. So, here you have two things. Actual price per kilogram is 4.25 and actual kilograms of material used is 22,000. So actual quantity is 22,000 and actual price is 4.25. Now let us see standard. Standard material X is required at the rate of 2 kilograms purchase at the rate of 4 per kg for producing 1 unit of output. Friends, we have to always understand that whenever you will have problem in the examination of whatever level, internal or external, you will never ever get standard for the actual production. Now here standard is given for producing 1 unit and the actual production is 10,000 units. So in such cases, the first and foremost thing that we have to do is that we have to calculate standards, that is standard price and standard quantity for 10,000 units produced. So for 1 unit of output, if 2 kilograms are required, then for 10,000 units, 2 into 10,000, 20,000 kilograms of material should have been used. So you see below the actual quantities, standard quantity is 20,000. How it is calculated, again I repeat. If for 1 unit of output, 2 kilograms of material X is required, then for 10,000 units produced, it has to be 10,000 into 2. That is the reason why, see in the second line in the following table, standard quantity of material X is 20,000 kilograms. Now standard price is given 4 rupees per kilogram, so that we have copied. So that is standard price, standard quantity. Actual price is directly given, that is 4.25 per kg. Here it is directly given, but in some problems it might not be, and that we'll see in the next problems. So 4.25 per kilogram is the actual price AP, and actual quantity is also given as 22,000 kilograms of material X, so AQ. So once we have SP, SQ, AP and AQ for 10,000 units manufactured, produced, we can simply put these amounts in the formulas, and then we can calculate material price variance, material usage variance, and material cost variance, and that we'll see in the next slide. So now first see material cost variance. What is material cost variance? It is standard material cost minus actual material cost. What is standard material cost? Standard price into standard quantity and minus what is actual material cost? Actual price into actual quantity. So standard price 4 into standard quantity 20,000, that comes to 80,000. Actual price 4.25 into actual quantity 22,000, that comes to 93,500. Now friends, here you can see the standard material cost is less and the actual material cost is more. So the answer is negative. And whenever answer is negative, it is adverse variance. So the difference 13,500A means material cost variance is 13,500 adverse. Now let us see the bifurcation of these two. Material cost variance, we know it is further bifurcated into material price variance and material usage variance. Now let us see material price variance first. Now you know it is the price, means difference between the price. So what is price? Standard price minus actual price. Friends, remember one thing, there are students who make a mistake by taking actual price first. It is always the standard price minus actual price. So always the standard cost has to come first. So whenever we are comparing price difference, it is SP minus AP, and that we have to always compare with the actual quantity and not the standard quantity. So in this case, you know, standard price per kilogram is 4, actual price per kilogram is 4.25, and that when we multiply with the actual 22,000 kilograms of the material is utilized, it is minus 0.25 into 22,000, that comes to minus 5,500, and that negative adverse variance, that is 5,500 material price variance, is called as adverse variance. Now material usage variance, usage. So here we are going to compare the difference between the quantity. Which quantity? Standard quantity that should have been utilized and consumed, and the actual quantity that is utilized or consumed. So it is SQ minus AQ into standard price per kilogram. So standard quantity was 20,000, actual quantity was 22,000, and multiplied by standard price rupees 4. So it is again negative 8,000, and negative 8,000 material usage variance we call as adverse material usage variance of rupees 8,000. This is how a simple problem is given and which could be solved in this manner. Let us have little bit difficult example where things are not given directly. Now, again here the unit produced are given say as 15,000 units, 44,000 kilograms of material P is consumed at the rate of say 7.5 per kilogram. Standard material P which is required to be consumed at the rate of say 30 kilograms at the rate of rupees 8 per kg for 10 units. Now in the earlier problem we were given for 1 unit how many kgs of material X was required. Now here it is for 10. Now as I said friends, whatever they might give you, now here they have given you for 10 units. In the previous example, say they are given you for 1 unit. You have to always calculate the standard for the actual production. And in this problem, the actual production is 15,000 units. So for 10 units, if 30 kgs of material P is required, then for 15,000, how many kgs are required? So it is 15,000 into 30 divided by 10, and that comes to 45,000 kgs. You can see the second row in the table, the calculation I have given you. So standard quantity of material P is 45,000 kgs. Standard price per kilogram is ready-made given 8 rupees per kilogram. So we know SP and SQ now. Now AP, actual price per kilogram is again readily given 7.5 per kg. So AP is 7.5, and then actual material use quantity is given as 44,000 kilograms, that is AQ. So once we have SP, SQ, AP and AQ for actual production of 15,000 units, now it is simply we have to put in the formulas like what we have seen in the previous solution, and we can calculate the variances. So let us see this variance calculation in the next slide. See here, material cost variance, that is standard material cost minus actual material cost. Again, SP into ESQ minus AP into AQ. SP8 and SP 45,000. So that comes to 3,60,000. AP into AQ comes to 7.5 into 44,000. That is 3,30,000. Here it is 30,000 positive. So 30,000 variance is favorable. Now, second, we have material price variance where we compare standard price and actual price and multiply by actual quantity consumed. So standard price 8, actual price 7.5 into 44,000. So we get here a positive difference of 22,000. So it is a 22,000 favorable material price variance. Now material usage variance. Usage means we compare what quantity. So standard quantity minus actual quantity, and that we multiply by standard price. So it is standard quantity 45,000 minus actual quantity 44,000. So for 1,000 units saved at the rate of 8 rupee, the business had saved 8,000 rupees on the consumption of the material. So here we have 8,000 as favorable material usage variance. And friends, you can see the total material price variance and material usage variance 22,000 plus 8,000. It is tallying with the 30,000 favorable material cost variance. So favorable plus favorable is equal to favorable variance. Now let us see a third example where they were given you little bit complicated where the things are not so readily given. So here again you are given the production is say of 25,000 units, 98,000 kilograms of material B is consumed. So actual quantity is 98,000. But here actual price per kilogram is not given this time. The total amount is given for 98,000 kilogram, that is 10 lakh 29,000 rupees. So from these friends, we have to calculate actual price per kilogram. How it will be calculated? You can see in the table, and that is a third line. It is 10 lakhs 29,000 total amount paid divided by 98,000 total material purchase, and that gives you rupees 10.50 per kilogram as the actual price per kilogram for material B. So actual price per kilogram is 10.5. Actual quantity 98,000. So we know AP and AQ now. Now let us see SP and SQ. Now standard price per kg is given as 10 rupees, but you are given that 400 kgs of material is required for producing 100 units. Friends, in the previous problem it was for 10 units. Earlier to that, it was 1 unit. So this could be given for any number of units. You please don't get confused. Whatever is given in the problem, you have to calculate what is the standard material required for the actual production. And actual production is not 100 units, it is 25,000 units. So if for 100 units, 4,000 kilograms of material B is required, then for 25,000 units, how many kilograms of material is required? So calculation I have given you in the second line in the table. It is 400 divided by 100 into 25,000, and that comes to 1 lakh kilograms of material. That is the standard quantity. So once we have SP as 10, SQ as 1 lakh, AP as 10.5, and AQ as 98,000, friends. Now the variance calculation is very simple. What is really difficult and what is to be concentrated by the students is this, that calculating the standard for the actual, and whenever the actual price or say actual quantity or standard quantity is not readily given, that actually calls for the working, and that is an important part of this variance calculation. Actual variance calculation is just putting figures in the formula, and that we have seen in the previous two solutions. Let us see in the next slide also. So material cost variance, you know, that is standard material cost minus actual material cost, SP into SQ. SP 10, SQ 1 lakh, so it is 10 lakhs, minus AP into AQ 10.5 into 98,000, that is 10 lakh 29,000. So here it is negative 29,000. So we will say the material cost variance is 29,000 negative. So it is 29,000 adverse. Now let us have material price variance. What is price variance? It is SP minus AP into AQ. SP 10 minus AP 10.5 multiplied by AQ 98,000. So this is positive 49,000, uh, negative rather. This is negative. Just a minute. This is negative. This is negative 49,000, and negative 49,000 is called as adverse variance. Means because of price of the material, business has paid 49,000 extra. So material price variance is 49,000 adverse. Now friends, let us go to material usage variance. Whenever it is usage variance, we compare difference between quantity. What is that? SQ minus AP and multiplied by standard price per unit kilogram. So standard quantity 1 lakh kgs, actual quantity 98,000 kgs. So difference is 2,000 positive multiplied by standard price. So we have 20,000 positive difference. So this is a favorable variance. So as far as material consumption is concerned, material usage is concerned, business has saved 20,000 rupees. So this is a favorable variance. Now friends, see price variance is negative, that is adverse. Material usage variance is positive, that is favorable. And when we add these two, I told you, you cannot add favorable to adverse and adverse to favorable. So in such a case, you have to take a difference. So how to take a difference? Bigger figure, that is 49,000. From that we have to minus the lesser figure, that is 20,000. So 49,000 minus 20,000, difference is 29,000. And since 49,000 is a bigger figure, that adverse sign will attach to that. And that is how the net difference is 29,000 adverse, and that is nothing but our material cost variance. So 49,000 adverse plus 20,000 favorable is equal to 29,000 adverse material cost variance. This is how the material variances are calculated.